Hey guys, it's Justin here from Keller Williams Realty, and I'm here with Jonathan.
Hey, I'm Jonathan from Integrity Tree Financial.
Yeah, we're just going to go over a couple questions that we normally get.
Sure. And you
Um,
know what? Let me go first, Justin, because I get this one all the time.
yeah,
And the question that I get put to me is what should be the first step that a buyer makes when looking to purchase a home?
yeah, for sure. So the first step is going to be getting your mortgage pre-approval. So before you even start looking at homes, you'll need to know how much you could spend, right? So getting your pre-approval is going to allow you to know exactly what you can spend, and it'll strengthen your position when it does come time to put in an offer. So you could reach out to myself or your bank or a mortgage specialist such as Jonathan. He'll be able to help you out the best. And is it right? They should be getting it on paper, so it'll usually last around 120 days. Is that right?
Yeah, that's right. It's typically between 90 to 120 days they'll hold rates for you.
Okay, great. And then now we're on the topic of mortgages. Would you be able to explain, because I get this question sometimes, the difference between a variable mortgage and a fixed mortgage?
Sure. Yeah, I mean, I think most people know the basics when it comes to those, but there are a number of nuances. I'll try and run through it quickly so that I can cover as much as possible. Obviously,
Yeah,
the fixed rate is king in most people's mind because people have a pretty low tolerance for risk, and they know that they're going to be paying the same amount every month for the term of their mortgage with that fixed rate. So it's comforting to know that, right? So a lot of people like the fixed. They know the payments throughout the 5 years. The fixed rate's governed by the bond market. So in Canada, the bond market just moved this week, and the rates have all moved up by 0.10 mostly. The downside to the fixed is the huge penalties. They call it an interest rate differential to calculate the penalty, and 60% of Canadians will break their mortgage in the first 3 years of a 5-year term, and that leads to a huge penalty. $500,000 mortgage, you're looking around 20 grand typically in penalties if you break in the first three, which is obviously very high. Variable is variable. So it moves. The Bank of Canada has 10 meetings a year to decide how the economy is going and whether they want to raise interest rates. And if they do raise the interest rates, then guess what? Your mortgage payment's going up. So a lot of people don't like that. However, it's historically low right now. It's a good product to have. The benefits to a variable is if you don't know your life situation in, say, 6 months, 3 years, you can break that with pretty low penalties. It's just 3 months worth of interest, which is considerably less than a fixed rate product.
right. So would you say that one's maybe superior to the other?
It really depends on the client's needs, which is why a pretty in-depth conversation is really important between myself and my clients, because if they're investors and they're looking to flip, then it's a variable all the way because they're going to be getting in and out of that property and they want the cheapest way to do so. And those cheap penalties are great with the variable. If it's someone who's got a family, they know they're not moving anywhere anytime soon, and they're living pretty close to their budget, they want a standard amount of payment every month, then it's going to be the fixed rate all the way to give them that peace of mind.
Right, makes sense. All right, great. Thanks so much for answering that for me.
Oh, thanks for having me
Um,
here, Justin.
yeah, and before I let everyone go, I just wanted to let you know we do have a buyer book. So if you're interested in more of the steps to purchasing a home, you could reach out to me. I could either drop this off or send you an email. Other than that, thanks so much.